Okay, so we're going to start out talking about credit risk analysis with the debt to equity ratio. And just like it sounds, it will be debt divided by equity, or debt to equity. All right? So, what does the debt to equity ratio tell us? Well, it tells us about solvency of the company. Solvency, yes. Defined as the possession of assets in excess of liabilities, or basically the ability to pay one's debts, what one owes. So the calculation is very simple. It's total liabilities divided by total stockholders' equity. Now, in some places, what you'll see is it's the total long-term liabilities divided by total stockholders' equity. So make sure you understand which one is being used. Now, a number that is greater than 1 means that you have more debt than both the stockholders have invested, what they've put in, and the net earnings that you have accumulated and added together. So again, that's what stockholders' equity really is. It's about what's been invested into the company plus the earnings minus the losses. So there's your stockholders' equity in its simplest form, and then you're dividing your total debt by that. So what are the advantages of having debt in the first place? Well, you can write off interest expense as a tax deduction. So if you have equity, you don't have that. But in debt, you're going to have to pay the bank both the principal and the interest expense. And on a business loan, that interest expense is tax deductible. Where in equity, what you do is you give people dividends, right? Dividends. It's not really the same as interest, and it's not deductible as an expense on your tax return. So managers can also maintain control when we have debt. Whereas equity, more shareholders mean more opinions, more input from other people. Whereas if a company doesn't want to have all these investors and shareholders giving them their opinion on how to run the company, they'll go get a bank loan or they'll go get debt. Now, it's easier to get debt for large purchases. Especially if you have a track record, you have a business that's been successful, you go to the bank, you show them the collateral that you have, and then the bank will give you that money for that asset you want. Whereas when you're going to have investors, now you've got to issue stock, you've got to collect that stock, sell that stock to be able to turn around and buy something. Hopefully you get enough through that investors. Well, hopefully the bank loans you enough for that large purchase you want either. But technically, it's easier, especially if you have some history and you have collateral, to go get a bank loan. And then finally, it's easier to budget, right? Because if I'm budgeting, I have set loan payments, I have with their principal and interest associated to that, and I can schedule that and put that into my budget. So why would you choose equity over debt? Well, the advantages of equity are there's no obligation to repay. Whereas in debt, the bank will want a regular payment, will want that principal portion of that debt back. But, technically you have no obligation to pay back an investor who invests the money in. So thank you for your money. I'm going to use it for my business. Hopefully we make money. Hopefully I can pay you dividends, but no obligation to do that. Nothing is collateralized when you have equity. Investors, here's our common stock. So essentially, you've got ownership in this business, but if I run it into the ground, there's nothing, so you get nothing. So there's no real collateral as far as what an investor has when compared to debt. So it's an advantage to the business to have equity as opposed to debt in that particular situation. Now, you have a potential for greater returns when you have that, because if you think about it, on my business, I have to deduct those interest payments, which will actually reduce my net income. Whereas when I'm got investors out there, I don't have to pay that interest because there's no requirement for interest, so my profits will look better. And even then, when I have dividend distributions, it's out of my past profits or equity, so it still doesn't affect my income statement. So I will, by nature, look more profitable when I have equity. So let's do some comparisons. Let's compare the semiconductor market for starters, right? Data provided from macrotrends.net. Purpose of this is, when we look at ratios, we typically say, oh, what's good and what's bad. Debt to equity is a little bit harder than that because, what is better, debt or equity? We just said there's advantages to both. So how much does this debt to equity really tell us? So let's compare it. So we've got NVIDIA. Everybody's talking about NVIDIA, one of the hottest stocks in the market right now. We've got AMD, which also sells semiconductors and is basically an up-and-coming stock that people are also putting a lot of money into. Then there's Intel, which is kind of the opposite. It's the old soldier of semiconductors, which they're struggling right now for profitability, struggling for market share. You got Micron Technologies, which is another one of the semiconductors that have been around for a little bit. And then there's Taiwan Semiconductor Manufacturing, done offshores of China in Taiwan, and is also a very popular stock right now. So if you look at this, which one of these do you think was founded first? Based on I would said, you'd think it'd probably be Intel or Micron, right? Well, yeah, it was Intel in 1968. But then next came AMD in 1969. So AMD has actually been around for quite a long time, even though it's gotten a lot of favor in the last couple of years as being an up-and-comer company. Then you've got Micron that came in 1978. And then you've got Taiwan Semiconductor, which was 1987. So that means NVIDIA is actually the youngest of these corporations in 1993. Most people know them because, from gaming industry, the NVIDIA graphics in your monitors, which is helps for that gaming effort. So that's why NVIDIA seems to be a very popular one. But now they've gotten into AI and really just revved up the services that they offer and the microchips that they provide. So let's look at their year-end January 31st, 24 data, where they had 9.4 in debt, 42.9 in equity. So they have a 0.2 debt to equity ratio, which tells me they have very little debt compared to their equity. Again, is that ratio good? Let's see how it compares. AMD, which again has been around a lot longer, December 31st, they had 1.7 billion in debt, 55 billion in equity, so a 0.3. So really very little debt in AMD. Intel, 46 billion in debt, 109 in equity, 0.43. Double what NVIDIA's is and significantly higher than AMD, but still a very solid entity as far as not having a ton of debt compared to the equity that they have. Micron, 13 billion in debt, 44 billion in equity, or a 0.30. So it's actually closer to Intel, but between Intel and NVIDIA as far as the debt to equity ratio goes. And finally, Taiwan Semiconductor, 30 billion in debt, 112 billion in equity. So 0.27 is debt to equity ratio. So if I was to look at this and try to evaluate what's better, is it better to be higher in equity? Is it better to be higher in debt? I don't know, maybe 50-50 is the best to do it. But if I was to judge the semiconductors, it seems like you'd want to be around that 25% in debt to equity to just be similar to your peer group. But that said, I don't know how important that really is to evaluate a company. Let's look at another market. How about the airline industry? So we've got Delta Airlines. We'll also look at Southwest Airlines. We'll look at United Airlines. And finally, American Airlines. So there are the 4 airlines that we're going to look at, and we'll see how they compare. Which one do you think was first? Well, it was United. United established in April of 1926. And American was actually established about a month later in 1926. So there's your two airlines that have been around almost 100 years now. Then you've got Delta that was in 1928, only a couple years later. And finally, Southwest, which is actually very young compared to the other companies, but still has been around, for a long time and started in 1966. So airline industry, let's think about that. They have a lot more, big equipment, right? So big equipment would tell me that they probably have a lot more debt, right? From what we said, easier to potentially get debt with collateral from loans and whatnot. So I'm thinking they're going to be higher in that debt to equity ratio. So here is Delta with 17 billion in debt, 11 billion in equity, or a 1.54. So again, it's over 1, so now we have more debt than we have equity in that relationship. Southwest, again, younger in comparison to the others, still been around a while, 7 billion in debt, 10 billion equity, so 0.76. Pretty good ratio. Owners still have the significant rule, as far as investors do, over the debt that's there. You've got United Airlines, which is 25 billion in debt, 9 billion in equity, or a 2.7. Wow, a lot of debt compared to the equity. Now remember, these two numbers, debt and equity, usually add up to the asset side, again, unless we're using just the long-term debt. But they usually add up to the asset side, so it really gives you an idea that most of the assets that United Airlines have was acquired through debt. Now finally, American Airlines. Hold on to your seats for this one. That's right, they have negative 5 billion in equity and 29 billion in debt. So they have a negative 5.6. This would tell me that they have a heavy amount of debt that they receive, that they have their assets based on. And really, they've got negative equity, which means they don't really have the earnings that they've accumulated to pay for the assets. In fact, they're going further in hole, so it's possible they might even have debt to have accumulated their, anything related to the equity. If they did dividends or something, maybe they borrowed to be able to give out those dividends. So now it's higher than 1 as far as if it's an absolute value, but it's a negative. So pretty much I would think if you come across a negative, that's not a great sign when you do your debt to equity ratio. One last comparison of industries. Burger chains, right? So we've got McDonald's. We're going to bring in Wendy's Corporation. We're also going to look at the Burger King entity, which is owned by Restaurant Brands International. And then we'll take the newer Shake Shack, and let's compare these. So we've got Wendy's that was founded in 1955. I'm sorry, that's McDonald's, founded in 1955. Wendy's was founded in 1969. Shake Shack was founded in 2004. Now here's the thing. Restaurant Brands International owns Burger King. They've been around a while, but QSR, or Restaurant Brands, formed after they bought Burger King, and Burger King was having some significant financial issues. So that's why it says they were founded in 2014, but we know Burger King's been around a lot longer than that. So let's look at McDonald's. The debt, 37 billion and 4 billion in equity, negative. Oh, here's that negative again. So McDonald's actually has a debt to equity ratio of negative almost 8. We'll talk about how important that is in a minute. So now Wendy's. Wendy's has 3 billion in debt, 0.3 in equity. So they have a debt to equity ratio of 10.66. So they've got all these brick and mortar places all around the US. They've had to pay for all those brick and mortar places. And so they've got significant amount of debt when you compare it to their equity. What about QSR, or the Burger King entity? 13 billion in debt, 4 in equity, so it's 2.78. So that's actually a better debt to equity ratio as far as getting closer to having an even split, but it's still significantly debt focused. And then finally, Shake Shack, which goes along the lines of what we have said of what's kind of ideal of having, not ideal again, what is really ideal with debt to equity? It depends on the entity, it depends on the type of entity it is. But you can see 0.25 billion in debt, 0.47 billion in equity, so it's a 0.52. So it's much lower than what you see with the other burger chains. And again, it's newer in theory compared to the ones that have been around since the 1950s and 60s. Let's look at the trends to see if maybe, since these numbers are just numbers that don't really tell us a whole lot other than the portion of debt to equity, let's see if trends helps us out a little bit. Okay, so now when we look at the trends of debt to equity, you'll see that in the latter years of 2023, McDonald's and Wendy's are really starting to have a higher significant portion of debt to equity. You can see if you go back to 2019, they were all kind of in that 5%, 5 times or -5 still with McDonald's, as far as where it was, or lower. But then obviously COVID presented some challenges for all these entities, and now McDonald's and Wendy's have a significant amount of debt compared to their equity, where the others have kind of stayed along in line with their normal debt to equity ratios. Maybe Shake Shack has bumped up just a little bit in the last couple years. So does trends really tell us anything? Well, it's told us essentially that McDonald's and Wendy's definitely had to borrow to struggle through to get through the COVID experience. But let's look at some other factors as to why maybe we shouldn't worry about this -10 by McDonald's. So let's look at the other factors. So McDonald's year end, 12/31/23. Working capital is something else we have to put into that. Working capital would mean, do I have more current liabilities, cash, inventory, receivables, than I do current debts? Accounts payable, paying my vendors for the food and things that I've bought for McDonald's. So kind of an operational look at current cash flow, current assets versus current liabilities. So when I subtract current assets minus current liabilities, I hope I have a positive number. And yes, McDonald's has a positive number. They have $1.1 billion. So in theory, McDonald's can pay all of its current debts over the next year without any problems, without having to go into further debt or the need to issue more shares to try to build the equity up. So maybe that crazy number that McDonald's had isn't so bad. In fact, when I look at free cash flow, and free cash flow means I've got operations on that are producing cash, and then I'm also expending into my capital expenditures. So I'm going to take what my burger business has made, subtract out any major capital expenditures I've had, and do I still have a positive cash flow? And yes, they do. In fact, they have $7.1 billion in positive cash flow. So it make me worry a lot less about McDonald's and that debt to equity ratio, and the fact that that equity is negative right now, even though negative equity does concern me. And then finally, let's do the Altman Z, which is a bankruptcy indicator. Altman was a professor who came up with a whole statistical calculation to determine whether a company potentially would be going bankrupt within the next 2 years. And when we run the numbers in the Altman Z, which we'll have a whole video on Altman Z, but it's that indicator of bankruptcy shows that McDonald's actually is in the safe zone. So they're not going to go bankrupt in the next couple of years. So in essence, that debt to equity ratio that we were all worried about, McDonald's looks pretty good when you look at other factors and other indicators, which is the lesson here. No one ratio tells you anything. You've got to look at other ratios together, comparable ones, similar ones, ones that help tell the story better. Reliance on one ratio is not a good thing. So let's go to summary on this. So in summary, here are the keys to making the debt to equity ratio relevant. 1. Make sure you compare to similar industry competitors, just like we did when we looked at the semiconductors, the airlines, and the burgers, to see if that's just the way that industry is. Because again, the airlines are going to have large expenses on airplanes. The burger industry is going to have expenses on brick and mortar entities, whereas the semiconductors won't have necessarily that large capital expenditure related to huge entities or huge brick and mortar operations. So it's important to compare to similar competitors. Second, also factor in how long those competitors have been in business. Because remember, there's going to be a difference between entities that have been around a long time, have weathered a lot of different storms, potentially have the assets and collaterals to incur more debt. So because they've been around a while, the banks will trust them to give them more debt. So again, that's something else you have to factor in when you're even looking at similar industry competitors. Next, you analyze the ratio over time to understand the trends, just like we did to see that potentially COVID has had a big impact on McDonald's and Wendy's. And then finally, do not use the ratio by itself to make a decision about the solvency of a company. Use other ratios, other indicators like we did with working capital, free cash flow, so that you'll make a very educated and good decision. And that is our video on the debt to equity ratio.